The real cost of college debt in the United States extends far beyond the initial dollar amount borrowed. While student loans can provide access to higher education and potential career growth, the financial, personal, and societal repercussions are often long-lasting and profound. Borrowers face years, if not decades, of repayment obligations, with compounding interest making the debt even harder to manage over time. This financial strain influences critical life decisions, such as career paths, homeownership, family planning, and even mental health, while also dampening broader economic growth by limiting consumer spending and entrepreneurship. Additionally, college debt disproportionately affects middle and lower-income families, reinforcing wealth inequalities that span generations. Without systemic policy changes, the burden of college debt will continue to grow, impacting not only individuals but also society as a whole by curtailing economic mobility and deepening financial disparities across communities. Number 6. Financial strain and lifetime earnings. Interest accumulation on student loans can lead to significant long-term costs that go well beyond the initial amount borrowed. For example, with federal loan interest rates ranging from 4.99% to 7.54%, a $30,000 loan can swell to a total repayment of $37,000 to $45,000 solely due to interest, and private loans often come with even higher rates. This growing debt burden creates a substantial opportunity cost, as graduates typically need to delay key financial milestones like purchasing a home, saving for retirement, or building up emergency funds. In fact, data from the Federal Reserve highlights that millennials have a 34% lower rate of homeownership compared to previous generations, with college debt being a primary factor. Furthermore, the pressure to begin repaying these loans often pushes graduates towards stable, lower-paying jobs instead of pursuing higher-paying or more fulfilling yet riskier roles that may require time to yield substantial returns. This shift toward lower earnings early in a career can lead to a snowball effect over time, as early salary levels set the foundation for future wage growth and career opportunities. Collectively, these factors result in a cumulative loss of lifetime earnings, as individuals with significant debt make career and financial compromises to manage their loans, creating a long-term impact that reverberates through their professional and personal lives. Number 5. Career and lifestyle choices. The weight of student debt often influences students' choices when selecting a major and planning a career. Many feel compelled to prioritize fields that promise higher salaries, such as business, engineering, or technology, over pursuing their true interests or passions in less lucrative areas like the arts, education, or social work, where starting salaries are often lower. This financial consideration reshapes career paths and, by extension, the diversity of talent in various industries. For those already burdened with student debt, the need to manage loan payments often forces them to work multiple jobs or overtime, sacrificing work-life balance and, consequently, their personal well-being and mental health. This demand for additional income can lead to burnout, leaving less time and energy for family, personal pursuits, or relaxation. Additionally, student debt curtails entrepreneurship and innovation. Graduates carrying debt are often hesitant to take on further financial risks, making them less likely to start their own businesses or invest in innovative projects. Consequently, loan-free peers are statistically more likely to venture into entrepreneurship, which in turn limits overall economic growth and societal innovation by suppressing the bold ideas and initiatives that often come from young entrepreneurs unencumbered by debt. Number 4. Mental health impact. The emotional toll of college debt is substantial, with many borrowers experiencing intense stress, anxiety, and even depression over their financial obligations. Managing monthly payments alongside other living expenses creates a constant feeling of financial strain that can erode mental health. A survey from Student Loan Planner found a disturbing link between student debt and mental health struggles, revealing that 1 in 15 borrowers have even contemplated suicide due to the overwhelming burden. This strain extends to personal relationships and family planning as well, with many debt holders delaying or reconsidering significant life milestones. Facing years of repayments, some borrowers feel compelled to postpone marriage or starting a family until they're in a more stable financial position. The weight of debt also creates pressure within relationships, as debt becomes a shared burden with partners, affecting joint financial decisions and future plans. This pervasive influence of college debt on both mental well-being and personal life highlights the far-reaching consequences that extend well beyond financial obligations, impacting individuals' emotional and relational lives in profound ways. Number 3. Impact on society and the economy. College debt significantly hampers economic mobility, especially for middle and lower-income families where debt is often highest. These families may take on substantial loans with the hope that a degree will offer upward mobility, but many borrowers from lower-income backgrounds struggle to keep up with repayments, worsening existing wealth disparities. As they channel a significant portion of their income toward loan payments, they miss out on opportunities to save, invest, or build wealth. This strain is felt across society as the heavy repayment burden curtails consumer spending, especially on big-ticket items like homes and cars, which are key drivers of the U.S. economy. When borrowers delay or avoid such purchases, the economy loses out on critical consumer demand, ultimately slowing growth. On a larger scale, defaults on federal loans, which disproportionately affect borrowers from disadvantaged backgrounds, create costs that taxpayers often shoulder. When these loans go unpaid, the financial strain shifts to the public, further stretching government resources and emphasizing the need for systemic solutions to ease the burden on individuals and society alike. Number 2. Generational burden and intergenerational wealth. Parent PLUS loans intended to help parents fund their children's education often place parents under significant financial strain, sometimes well into their retirement years. As parents take on these loans, they face the challenge of balancing their own financial needs, such as saving for retirement, with the repayment of educational debt, which can leave them financially vulnerable. The implications extend to wealth transfer, as the resources that might have gone toward building and passing on wealth are instead redirected to loan payments. This diminishes the financial legacy parents can leave for their children, impacting generational wealth building. For the younger generation, the weight of student debt similarly restricts their ability to accumulate wealth. Graduates with high levels of debt often delay or forego major financial investments, such as buying a home, starting a business, or investing in retirement funds. As they work to pay off their loans, their capacity to build savings or assets that could be passed on to future generations is diminished. Unlike previous generations, which could more feasibly build and transfer wealth, today's graduates may struggle to help their children fund education or homeownership, perpetuating a cycle where debt hampers each successive generation's financial prospects. Number 1. Policy and debt relief challenges. Federal student loan policies have often compounded the challenges borrowers face by enforcing high interest rates and rigid repayment structures that leave little flexibility for those experiencing financial strain. Interest typically compounded over time, meaning that even with regular payments, many borrowers find their loan balances growing rather than shrinking, particularly if they can only manage minimum payments. These policies can feel punishing, as borrowers who fall behind or face economic hardships have limited options for adapting their repayment plans to fit their circumstances. Temporary relief measures exist, but they tend to be narrow in scope, difficult to qualify for, or administratively complex, limiting their accessibility and effectiveness. Although proposals for broad, lasting debt relief could offer relief to millions, they are mired in political contention, with debates centering around economic impact, fairness, and funding. This lack of policy reform leaves the burden on individual borrowers, who face long-term financial strain that hinders not only their economic mobility, but also broader societal health. As debt levels continue to climb, the broader consequences grow, from reduced consumer spending and delayed homeownership to stagnant economic growth and limited career flexibility, with the persistent burden of student loans reinforcing cycles of wealth inequality and drawing on public resources when defaults occur. Without significant and comprehensive policy changes, the long-term impact of student debt will continue to deepen, affecting both individual financial well-being and societal economic stability. Thanks for watching and subscribing channel.